So welcome back to another session. Our focus for this session today is on planned assets. Last week we would have looked at financial assets, and we know that financial assets, they're current assets. So today we're putting our focus to another type of assets, finding out what it is, how do we account for it, and to work a few questions after. So, what are planned assets? So here we're saying planned assets, another name for it is fixed assets. And we can recall fixed assets when we were doing our balance sheet. And we're saying here that for obvious reasons, it's an asset, right? And from our accounting equation, we remember that our accounting equation states assets equal liabilities plus owner's equity. And we give a definition of what assets are. And we said that assets are the economic resources owned by a business. So, with that, we're now understanding that there are different types of assets because last week we looked at financial assets and we knew that financial assets, those were current assets. So, let's look a little closer at what planned assets are, what fixed assets are. So a plant asset is an asset with a useful life of more than 1 year that is used in producing revenues in an entity's operations. So they are intended to be used over more than one accounting period, right? They're recorded at their cost, and a depreciation expense is recorded during their useful lives, right? So here we know a plant asset is an asset, but the type of asset that it is used in the production, in the operations of the business, in producing revenue. And because it's used in operations, right, it has a useful life for more than 1 year. So it extends and it moves beyond different accounting periods. So remember, you'll do financial statements for each accounting period. What you're seeing is that your planned assets, your fixed assets, you'll be seeing them across your financial period, your financial year, your accounting year. So, because we know what fixed assets are, so now when we know that in our balance sheet, you have fixed assets and current assets. So let's look at a comparison between the two. Let's start with fixed assets. So fixed assets, we're saying these are a company's long-term investments, right? Their useful life. They have a useful life of more than 1 year, and that's why we said they extend beyond one accounting period, right? They cannot be converted to cash easily. They're required for the long-term needs of a business because they're long-term investments. They're reported on the balance sheet at the price at which they're paid for, and they're adjusted for depreciation and amortization. And remember, before we spoke about that they're entered on the balance sheet at the cost and the depreciation expense. Yes, this is it. So some examples of fixed assets, right? You have land, you have property, plants and equipment, you have motor vehicles, you have trademarks, you have long-term investments, and you have goodwill. So let's turn our eyes to what our current assets are. So these. So we can see just by the first one, a company's short-term investment. So we're seeing, okay, more and likely it's gonna be the opposite. Because if it's not fixed, if it's not long-term, it's short-term, right? So our current assets are a company's short-term investments. They are usually held for less than a year, up to 1 year. They can easily be converted to cash. These are resources that a company needs to run its day-to-day operations and to pay its current expenses. So these are not for the long-term needs of the business, but for the daily operations, right? They're generally reported on the balance sheet at their current or their market prices. And we can see this was the case for our financial assets, right? And examples of these includes cash and cash equivalents, as you would have known, or accounts receivable, which is another financial assets. Then we have prepaid expenses, we have inventory, and we have marketable securities, right? So again, there are three categories for our planned assets. How do we categorize these? Categorize them as tangible assets, and these have a physical substance, and this includes your land and your building and your equipment. Something is there that you can touch and see. You have natural resources, and these are sites acquired for extracting inventory such as oil, mines, and reserves, right? So these are natural resources, and as the name says, and as you would know, what are natural resources? Natural resources are fixed assets, right? And the last one is intangible assets. So there is nothing physically there, there's no physical substance. And this includes your goodwill, your patents, and your copyright. These are not things that you can touch, but they're from some contractual agreement, right? So there are three categories for planned assets. So we come back. Planned assets, fixed assets, right? More than 1 year useful life, right? Use in producing revenue. But this time, we're looking at this last sentence. They're recorded at their cost, and depreciation expenses recorded during their useful life. Let's dissect the first part. They are recorded at their cost. How do we account for tangible assets? And we're narrowing on tangible assets here, and the fact that they're recorded at their cost. So the cost of a tangible asset, or the cost of a fixed asset, and these tangible assets are what were the examples we got before? We got building, we got equipment, we got land. So those are the assets that we're focusing on in this video. So the cost of a tangible fixed asset includes all amounts paid to acquire the asset and to prepare it for its intended use. So all the costs to be included includes some of the following. It's not limited to it, but these are the most known and popular ones. So you'd have the original cost of the original selling price, right? Any commission that you paid to acquire this asset, any transportation or delivery fees, installation or testing fees that you paid, that would make up the cost for the item, right? Did you receive any discounts or any further deduction from deals, right? You have to deduct that from it. Then you have any legal fees or taxes that you paid. So all these costs, all these amounts together gives you the cost for the asset. Because even if it was not the selling price, you still had to pay to prepare it for its intended use. So it's a part of the cost. So we have looked at that part, that they're recorded at their cost, the cost to bring it to its intended use. And let's look at the last part. A depreciation expense is recorded, right? So that's what we're looking at. What is depreciation, right? So we say depreciation is the process of allocating the cost that we found just now based on the selling price and any other cost that you incur to bring it to its intended use, right? So it's the process of allocating that cost over the economic useful life of an asset. And what we mean by economic useful life, over the time that you have the assets, or over the time that the asset will be used and will be efficient and effective in carrying out its intended use, right? So we're depreciating, we're allocating the cost over its useful life. Depreciation comes about as a result of the general wear and tear in an asset, changes in technology, and so forth. So we're saying, yes, we have this asset and it is new and we purchased it. However, because of using it over time, it will not be as efficient and effective. The value will not be the same, right? There are parts of it that might stop functioning, that needs to be repaired. So we have to consider the wear and tear of it, the wear and tear of using these items, and not just using these items, but changes in technology. So, you know, after a few years, this software might be outdated. So that's what depreciation is, right? And it's typically, and to sum it, it's the fall in the value of the asset. And as we said before, you purchased it today because of using it, the wear and tear of using it and using it for what it's intended for, right? The value of it will decrease. So we need to know methods of accounting for depreciation, methods of calculating this wear and tear. How do we put a value to this decrease, right? So the most commonly used methods are the straight line or the fixed installment method, units of production method, the sum of years digits method, and the reducing or the declining balance method. And we'll go and we'll explain and expound a bit more on these four methods of depreciation. But an important point to know that in determining depreciation, you must know the capitalized cost of a fixed asset. And that was what we did not too long ago when we said it's the total cost that you paid for the asset to bring it to its intended use. So that includes the selling price and any other additional fees that you paid to bring up an item, to prepare an item for its intended use. So we need to know that cost. We need to know the economic useful life of the asset, right? How long is this asset usually used for, and it's still effective and efficient. And we need to know the residual value of the asset, and that is just the expected cash value at the end of its useful life. So after using an asset over time, this residual value is the value that if you decide that at the end of the useful life, okay, this is the price, or the price, yes, the price that I could sell it for. So that's the residual value. And in doing depreciation using any of the methods, these are the three basic information you must have. You might need other information for others, but these three are common to all the methods that we discussed just now. So we have the methods here. So we're going to go in further detail with them, starting with the straight line method. So this method assumes that the fixed asset is depreciated by the same amount every year. Hence, the cost is allocated equally over the life of the asset, right? So here we have the formula. It says annual depreciation is equal to the capitalized cost of the asset minus the residual value of the asset, and we're dividing by the economic useful life in years of the asset. So whatever figure you've gotten at the start of acquiring this asset, this is the depreciation figure that will remain throughout the useful life of the assets, and at the end of it, right, you should be left only with the residual value. The next method is units of production method. So this method allocates a fixed amount of depreciation to each unit of production. So it's not like the straight line method where it's assumed that the fixed asset is depreciated by the same amount every year, right? And cost is allocated equally. This method says that a fixed amount of depreciation is to each unit, per unit figure, and unit can be miles, units, hours, etc. So it is the useful life for assets that depreciates due to wear and tear, and these includes trucks. So trucks is by mileage, cars, right? So these are assets that will use this method. So how do we find depreciation for this asset? So first we have the depreciation in units, and that is your capitalized cost minus your residual value. And this time we're dividing by economic useful life in units. So we're saying what's the total units, right? What's the total units this asset should give us for its whole life, right? So first we find that per unit, then we multiply that per unit figure by the total number of units of outputs, right? So we'll have the per unit depreciation multiplied by your units of output per year. And every year you'll have a unit of output that you expect for this asset, right? So once you've calculated your depreciation per unit, you would have multiplied by, so in year one, how much units of output should I get from this figure? Multiply that by your depreciation per unit, and you continue that every year. So that's for the units of production method. Let's look at the sum of the years digit. So in this method, it is similar to the reducing balance method, as a different amount of depreciation is charged each year over the useful life of the asset. So unlike the straight line, it's the same amount over the useful life. For the sum of digits, it's a different amount. And it says that the highest depreciation is in the first year and the lowest is in the last year. So how do we calculate it? We're saying here first, the capitalized cost, and we know what that is, minus our residual value, right? So the figure from that, we're multiplying by the remaining useful life, and we're dividing by the sum of years digit. So the remaining useful life is that we'll see when we just acquired the asset, because that's when we'll do the depreciation for the year. So in the first year, depending on the amount of years that you have left, that's what you'll put there. But the sum of years digit is what we'll speak about when we're doing a question. But let's talk about it a little bit here. So what the sum of years digit is saying is that all we're doing is summing the digits of the amount of years that you'll have this asset. So let's say we have an asset and we're saying the useful life is 3 years. The sum of years digit will be 3 years plus 2 years plus 1 year. So that's a total of 6. So the sum of years digit will be 6. So all it is summing really the years, digits, the digits. So you'll have it for 3 years. Then after 3 years, you'll have it for another 2 years. Then after that, you'll have it for 1 year. So you're summing those digits. If you had it for 4 years, you'll be summing 4, 3, 2, and 1, and so on and so forth, right? And then you'll be putting over that on each year. So this again, you're finding a different amount each year, because after each year, you'll know what's the remaining useful life. However, the capitalized cost and the residual value remains the same, and so does the sum of years and digits. That remains the same. So whatever question we have, we'll be able to clear that more in a question. But I hope you might have understood a little bit what it is. Let's look at the last one, which is the reducing or the double declining balance method. So in this method, a fixed percentage is taken from the balance of the cost of the fixed assets remaining at the end of each accounting period. So a fixed percentage is taken from the balance of the cost of the assets remaining at the end of each accounting period. So what this is saying is that at the end of each accounting period, you need to know what's the balance left on this asset. What's the value of this asset after this accounting period? And essentially what this is considered the net book value. And how we calculate net book value is the cost. So that's the capitalized cost minus your accumulated depreciation. And your accumulated depreciation, as the name suggests, you're accumulating your depreciation figure, right? So that is the sum of all depreciation for that asset up to a particular time. So you'll find that value, and then a fixed percentage of that value is what you'll take each year. So each year you'll find, okay, what's the net book value? Then you'll multiply that by a fixed percentage. So that's depreciation for that year. Next year, you'll then say, okay, what is now the new net book value? Then find a fixed percentage of that one. And we'll see how it works when we're doing our question. So this method allows for more depreciation to be charged in the earlier year of the assets, right? In the earlier years as the asset's efficiency decreases with time. And to explain this, what it's saying is that, so in the earlier years, you'll have a greater value, right? Because if each year you subtract the accumulated depreciation, you'll be getting a lower value to be charging a fixed percentage off. So with a higher value in the higher years, which is before you would have taken out your accumulated depreciation, you'd be charging a higher depreciation value in the earlier years. And that is true because when you just acquired an asset, it's at its full capacity, right? So you want to ensure that you're charging more depreciation then rather than at the end where, okay, it might be a little shaky, not working so properly, right? So the depreciation method, this provides for a higher depreciation charge in the first year of the asset's life and gradually decreases in subsequent year are called accelerated depreciation method. So the reducing balance method is an accelerated depreciation method. And what's the formula? So in calculating the reducing balance method, there is a depreciation rate that you must find, and that is 2 times the straight line rate. And in doing our question, we'll see what that is based on the straight line method. So first we find the depreciation rate, which is 2 times the straight line method. Then we use that and we say the annual depreciation expense will be the remaining book value. So remember from before, right? We have to find the net book value of the assets at each year. Then we multiply that by the reducing balance rate, and that's the depreciation rate, which is 2 times the straight line rate. The residue or residual value is ignored until the last year. So in the other 3 methods, you can see where we subtracted our residual value in our formula. In the reducing balance method, the residue is ignored until or last year. And again, we'll see how this looks in a question. So let's continue accounting for depreciation because we've spoken about all 4 methods of accounting for depreciation, right? So what we're saying is that for all methods, when recording depreciation, we debit the depreciation expense and credit accumulated depreciation. So it doesn't matter what method that you're doing, if you're doing the straight line or the reducing balance method or the units produced or the sum of the recording of depreciation is the same for all methods. It's a debit depreciation expense and a credit to accumulated depreciation. So regardless of the method used, the same total amount of depreciation will be written off over the economic useful life of the asset. So at the end of the asset's useful life, your total depreciation, your total amount that you're saying this asset was depreciated by should be the same for each asset. On a year-to-year basis, it will be different. It should be different. However, at the end of the useful life of the asset, the same total amount of depreciation should have been written off regardless of your method used. So the methods that you use simply cause timing differences in recording the annual depreciation expense. And that was what I was saying. The year-to-year figures will be different. They will differ. However, so year 1 depreciation for the straight line will be different from year 1 for the reducing balance will be different from, that's what it means. However, at the end again, regardless of the method used, the same amount for the total depreciation should be written off for the economic useful life of the asset. But the straight line method is the most popular method because what you just want to calculate it one time, and from you calculating from the beginning of the asset, that's the same figure you'll be recording for every year, right? So this is the end of just giving you an overview what plant assets are, how do we account for them. Remember, we have to account for them by recording the cost that you paid for it, right? And that cost includes the selling price and any other cost that was used to acquire the assets and to bring it to its intended use. So after we know that cost, we know that by using this asset, it won't be as efficient and effective, right? So we have to do something that's called depreciation, right? And we're saying depreciation is the process of allocating that cost over the useful life of the asset. It's determining the wear and tear of this asset because of using it, right? And we spoke about different methods that we can account for depreciation. So in our next video, we'll be looking at and we'll be attempting a question, right? So it's the same question and we'll be using the different methods of depreciation to drive out to our points and to explain the various methods. So stay tuned, right? And we'll see you for our next video.